Okay, well, those are the big headlines at this hour. Let me now first introduce our very first guest on the show, and that is Mahendra Jajoo, the CIO for Fixed Income with Mirae Asset Management. Mr. Jajoo, thank you so much for taking our time and joining us. You know, I think at this juncture, a lot of our retail investors, obviously they know that the momentum and the volatility in yield affects bond prices, and bond price movement in turn affects debt funds. But for those, let's say, who don't know, who are tuning into the Money Show, tuning into you for the first time, let's get back to the basics then. We are seeing a lot of momentum, a lot of up and down, or rather first down and up in yields. Mr. Jajoo, how does that affect bond prices and concomitantly debt funds?
So of late, we have seen the inflation go up, not only in India, but in most parts of the world, especially in the US. The headline inflation is now around 5.5%. So that had led to some scare of the bond yields going up in the previous month. But in the last 15 days, somehow there has been a strong correction in the yields in the US markets. The US yields have now fallen to about 1.20%, which is keeping the yield spread between 2-year and 10-year at about 100 basis points. So the bond market seems to indicate that the inflation, which has risen very sharply over the last few months, is possibly going to start easing in the coming months. The temporary disruption caused because of the sudden and the fast reopening of the economies in the Western world, especially in the US, is going to level out. We have also seen the commodity prices stabilize. We have seen the oil prices go up sharply to around $80 per barrel. And now in the last couple of days, we have seen a significant correction. So I believe that while the yields have inched up somewhat, overall, it has not had very significant impact on the debt funds. Debt funds continue to give returns which are meaningfully higher than the corresponding options, especially including the bank deposits. So while there is going to be higher volatility in the debt funds because of the current uncertainty in the bond markets, driven by the higher bond supplies because of the larger government borrowing program and some rise in the inflation in the past couple of months, but that worst seems to be behind us. So we should expect some stability in the bond yields going forward. On top of that, the Reserve Bank, in our case, has been very, very strong in its commitment to support growth recovery. And therefore, they have taken a number of measures. They have adopted a number of tools like the Government Securities Acquisition Program. So I think the concern over very high volatility is perhaps a little bit overplayed. Investors should remain, invested. And I believe that in the next year or so, again, the bond funds will give reasonable returns.
Okay, so really, perhaps this massive volatility that we've been reading in the newspapers, what we've been watching on our screens, maybe a little overplay the concerns around that, and debt fund holders at this point don't have anything to worry about. So, Mr. Jajoo, as a debt fund holder, let's say when we say that debt fund holders invest for a certain goal, right? And maybe I was looking to slowly redeem some of my debt funds. So, at this juncture, whatever the case may be, at this juncture, would that be the right time, or should we just hold off a little bit before we take any action on debt funds?
So it essentially is a function of what is the investment horizon and whether there is a mismatch between the fund in which the investor has put his money and his expectation. Because let's say, for example, if someone has come from a long-term perspective, he has an investment horizon of 3 years, then the current volatility in the market is part of the investing process. One has to go through this volatile phase to be able to generate better returns over a longer period of time by making the volatility work in their favor. And then if someone has, for example, invested in short-term funds or liquid funds with a very short-term investment horizon, then he needs to react accordingly. Broadly, what I'm saying is that as long as the investor has a long-term horizon and his money is invested in a fund matching his risk-return profile, then he doesn't need to worry too much about the volatility, which is part of the investment process. Over a longer period, we have seen in the past bond funds have given very good returns in the zone of 9 to 10%. Those kind of returns will come in future. But if there is a mismatch between either the investor's risk profile or his investment choice, then I think they need to take corrective action now.
Okay, understood. Now, Mr. Jajoo, you shared a brief outlook on what you expect yields to do going forward. I just wanted to understand that based on what we are seeing so far in terms of inflation, you are seeing slowly that oil prices as well cooled off a little bit. How are inflation and yields really related? And if inflation continues the way it is, the most recent reading as well in India of inflation was more than 6%, would fixed income, would debt MFs be enough to protect the purchasing power of of those investors?
So inflation and the bond prices are inversely related. The higher the inflation, the higher typically is the cost of money, and therefore the bond prices will tend to fall. And therefore the fear always was that the inflation continues to inch higher, then possibly at some point the NAVs will dip, and that could cause some negative return for a short period to the investors. Now, that is the general approach. But at this point in time, because of the COVID-related disruption and the scare on the growth, the global central banks everywhere, starting from Fed to our Reserve Bank, are totally focused on making sure that the growth does not falter, and therefore inflation has taken somewhat of a backseat. And therefore, as you rightly said, it is possible that the end returns in the debt funds may be slightly lower than the inflation. So there is a depletion in the net purchasing power of the investors in the economic sense. But then that is only one part of the investing equation. The other equation is how does the other options compare. So to then beat inflation, either the investor has to go and get into higher volatile and therefore considered higher risky assets like equities or commodities. But if the investor's basic risk profile or the asset allocation does not allow for that, then they have to temporarily accept what is the market return. What we understand is that the debt funds will continue to outperform the other options available within the debt space. Therefore, I expect the bond funds to continue to give better return than the fixed deposits or the tax-free bonds. Therefore, I think the investors have to make one of the two choices. Either they move into a asset class like equity or commodities, which can give potentially inflation-beating returns, but then the risk profile of his investments will accordingly change. Or the other option is, given the over-sensitivity of the central banks with regard to growth and therefore tolerating higher inflation for the time being, they can accept a slightly lower return but stick to their fixed income allocation. That is the perspective in which I think they need to look at the whole investment approach right now.
All right. So yes, maybe debt funds may find themselves in a bit of a tricky spot, but if you are somebody who is a fixed income investor, then within the entire umbrella, Mr. Jajoo is confident that it is debt funds which will give the best returns. If you want absolutely inflation-beating returns, then that's, and you want multi-bag returns, then obviously that's possible only through equities. But then be aware that those carry that kind of commensurate risk as well. Debt funds, fixed income are low risk products, or relatively lower risk products, and that's one of the reasons why the returns as well are not as blockbuster as equity. So with the benefits, the cons as well do come along. And Mr. Jajoo shared what his view as well will be going forward when it comes to inflation. You know by now that inflation and bond prices are inversely related. Inflation may be temporary, so if inflation goes down, perhaps bond prices will go up, and that will lead to debt funds as well doing well. So, excuse me. Mr. Jajoo, so far we've not seen, so far this year rather, in these last 6-7 months, we've not seen debt funds do as well as perhaps what we saw last year. Take, for example, a long duration fund. Is the reason the fact that the inflation made a comeback? Is that one of the reasons why?
Basically, last year we saw the yields fall aggressively. So, because of the fact that we got $100 billion of increase in the forex reserve, which brought in a lot of liquidity into the domestic system, and then the credit pickup has been very, very anemic. Reserve Bank has been focused on reviving growth, so they kept adequate liquidity in the system. They took a number of measures to keep the bond yields under check, and the debt funds benefited because of that. Right now, we are in a situation where possibly the yields cannot come down from the current levels, because our base case for the inflation for the current year is at about 5% and the repo rate is already at 4%. So possibly there is no room for the rates to be cut from here. But the flip side is that because of the aggressive intervention by the Reserve Bank, the bond yields have largely been stable and steady. There hasn't been any major upside movement so far observed, and because of which the debt funds have all given positive return. There is no negative return. Bond funds, all debt funds have given returns generally higher than the corresponding options like bank fixed deposits. So the return profile has come down because there isn't any capital gain element that the bond funds are witnessing right now because of the range bound interest rates. But as I said that if the investors sit through a complete interest rate cycle, then they can expect the same higher returns going forward. But at this point in time, yes, the absolute return levels have somewhat come down, but still they are positive. They are higher than the comparable fixed income options. And at this point, it is also important for investors to have a little bit of safety net given the high amount of uncertainty in the market. These are the phases of market cycle. So the best response to this for a long-term investor is to stick to his portfolio asset allocation and right through the volatility and phases of lower return, sit through the complete interest rate cycle to enjoy the higher returns as in the past.
Okay. So far, Mr. Jajoo, we've been speaking about all debt funds as a category. But, within that category, there are various subcategories as well. Long duration, short duration, medium, liquid, so on and so forth. Given your views on, yields and inflation, for retail investors, what would you recommend as the best debt fund mix?
So there is no one best debt fund because it's very important to look at the investor's risk appetite and his investment horizon. My view is that if the investor is either concerned with too much volatility in debt funds, or if he has a shorter investment horizon, then he should invest in short duration fund. Now, when we talk about debt funds, in broad terms, the duration refers to the overall maturity of the investments of the fund and the volatility associated with that. The longer the maturity of the fund portfolio, the higher is the possible volatility when the interest rates move. Therefore, the investors who have, let's say, invested for 6 months or 1 year, or who do not have a high tolerance to volatility in the NAV, they should invest in the short duration fund or the still lower maturity funds like low duration category. But people who invest in debt for long term and who want to maximize their return, they should stick to the bond funds or the long duration funds, because our expectation is that as the interest rates go up, the fund managers will get opportunity to invest new money that comes into the fund and the existing investments which mature at the higher yields. And therefore, let's say after 1 month, 1 year or 18 months, when the interest rate environment again improves, then the capital gains will start to flow in, and that will mean that the funds can again give 8, 9, 10% return. Therefore, rather than looking at one narrow choice, the investor needs to match their return expectation with their risk profile and choose the product accordingly. I think that will result in a very happy experience of investing for all categories of the debt investors.
Okay, there's no one size fits all. It's best to always consult a financial advisor as well. Every investor is different. Everyone's needs, appetites, etc. is different. So, it's best to consult an independent, your financial advisor on the same. Okay, and Mrs. Jajoo, one last question. I want to ask you this about one category of debt funds that have actually surpassed everything, and that's gilt funds. I think an average 10% return in the last 3 years, which is definitely no mean feat. Now, what do you think would be the recommended action for the current gilt fund holders? You mentioned that a lot of government paper will be flooding the market, and simple demand supply, like you mentioned, says that if there's more supply, there will be a tendency that prices will find themselves under a little pressure. So after this double-digit return for the last 3 years, could now be a good time to perhaps consider booking some profits from this category?
So, in my view, the 10% return or near 10% return for the gilt funds is not only for last 3 years, but for last 25 years that the gilt funds have been in existence. This has been a very, very appreciated category. What we need to really understand is that over the last 20 years, India's macro fundamentals have continued to improve. And from an economy which had 15% interest rates, like a grossly underdeveloped or underdeveloping economy, we have now moved closer to a 6% kind of a band for the 10-year. And then if you look at the global environment, and then if you look at the developed countries like US or, in many countries in Europe, the interest rates are in 1 to 1.5, 2% bracket. If you look at countries like Malaysia or Thailand or even, in those countries also, the 10-year yields are somewhere in the 2 to 3% band. The global central banks are continuously getting more and more involved with supporting the growth. So therefore, universally, we are seeing the interest rates trending towards zero. And India's macro fundamentals are still very strong. India is one of the most favored destination for the foreign capital, whether it is FDI or whether it is the foreign portfolio flows on the equity side. Therefore, if we expect the India's macro fundamentals to continue to improve in coming years, then I would expect interest rates to continue to come down. And within that, we will have these episodes where the interest rate environment will look very challenging. It will seem as if interest rates are going to go, through the roof. Inflation will be concerning. But then if you look at the inflation, last year we had the inflation in the range of 7.5% to 3%. In the last 3 years, from 2018 to 2021, we have seen 6% on 10-year, and then we saw almost 9% on 10-year. Now, today, the 10% return in the gilt funds that we are seeing is a function of the 9% becoming 6%. Before that, 6% became 9%. So, therefore, if the investor has made good money, but if his investment horizon is about to get over, then only he should redeem. But even if he has made 10% return in last 3 years, and if he still has another 3 to 5 years investment horizon left, then I think the best action is to not do anything, let the money continue to earn further, and wait through patiently with the current volatility phase, because once the volatility is getting over, then the next phase of the higher returns will start. So rather than worrying too much and getting worked up with the current uncertainty or negative feelers, the best strategy is to remain invested as long as the investor believes that India's macro fundamentals will continue to improve in the next 5 years like they have improved in the last 20 years.
Well, on that optimistic note, Mr. Jajoo, we'll end our conversation. Thank you so much for joining us and enlightening all of our viewers with your thoughts and views on debt funds.
Thank you.
Okay. Okay, well, we'll take a short break on the show, but here's a little bit of a teaser of what's coming up next. As we emerge from the second wave impact, reports of the third wave hitting by August end are already doing the rounds. On the back of this, a lot of insurance brokers are expecting a possible hike in insurance premiums. So up next, my colleague Alex Matthews will join us with an interesting conversation with Harshvardhan Rungta on the rise in premiums. How should one go about buying one? Stay tuned.